name is Munaf. I'm a financial planner with GMI. I specialize in investment and retirement planning, and this is my last video in my 6-part series that I'm creating on tax saving strategies at retirement. If you haven't watched the other videos, you can find them on our YouTube channel. In this video, I'd like to talk about the retirement annuity and how it can be used in one's retirement as a tax savings tool. Traditionally, a retirement annuity is a retirement savings product. So before retirement, you contribute to the retirement annuity or the RA, and then you use your retirement savings for your retirement income plan. But there are some instances where a retiree in their retirement can still use a retirement annuity product to save them tax. There are two specific instances or two scenarios that I'd like to share with you today on where an RA can be useful and can save a retiree tax in their retirement. But before I do that, I first want to make 2 points regarding an RA that I think is important for you to be aware of, because it'll also help you understand how a retirement annuity can be used in one's retirement to save them tax. The first thing to know about an RA is that if the balance in your RA is under 247,500 Rand, you can withdraw the entire amount as a lump sum into your bank account. You do not need to convert the 2/3 into an annuity product if the balance is under 247,500. Also key to know is that with product providers, they consider your total RA products that you have with them. So if you have 3 RA products with a specific product provider and each one has 200,000 Rand in it, then even though each RA product is under 247,500, because the combined value of your retirement funds with that specific product provider is greater than 247,500, you will not be allowed to withdraw it as a lump sum. So yeah, just important to be aware of that. But that aside, if you have a single RA product with a specific product provider, and if it's under 247,500, you can withdraw that as a lump sum. The second thing to be aware of is that the tax tables that apply on that lump sum withdrawal is different to the tax tables that apply on the income that you receive from your annuity. So there's 2 tax tables here. The one is the retirement tax tables, which is where the tax-free portion, that 550,000 Rand tax-free portion comes from. And that's the lump sum that you draw from a retirement fund is taxed as per the retirement tax tables. The annuity income that you get is taxed as per the marginal tax rates, so the individual tax tables. And basically, in your retirement, if there's any opportunity to, I guess you could say, arbitrage between the 2 tax tables, then you can save yourself tax. So it's just about being aware on which tax bracket you fall into in terms of the marginal tax brackets, and then if there's any opportunity to, I guess, use the retirement tax table. So you contribute to an RA and use the retirement tax tables and be taxed as per the retirement tax tables. If there is a gap, if there is that, you could say an arbitrage opportunity, if that exists, then you can save tax by using the retirement annuity. So that's the logic behind where retirement annuity could be used in one's retirement. But a common scenario that I've come across is where a retiree is receiving their annuity income, and then in that year, they either find work, contract work, consulting work, or they somehow earn additional income that pushes them into a higher tax bracket. So now they suddenly don't need all that income that they've earned for that tax year, and they're now being pushed into a higher tax bracket, but they don't need that income. And with the life annuity as a retirement income product, you can't stop that income that you receive. So you will have to receive that same income every month for that year. And with the living annuity also, you can only change the income on anniversary date. So you're also, in a way, forced to receive the income that you have been receiving from the living annuity until anniversary date. So there are instances where you may find yourself earning additional income from another source and it pushes you up into a higher tax bracket, and then you pay more tax. In that instance, it can be useful then to use the RA, contribute to the RA, and reduce your taxable income in your as per the marginal tax rates by contributing to the retirement annuity. And it is important to be aware of then what do you want to do with the retirement savings. If you're going to just take the retirement savings and put it back into your retirement income product, then that's perfectly all right, because that's tax efficient. By transferring it back into the retirement income product, you're not going to incur any tax. If you are withdrawing, if you're going to withdraw the lump sum from your retirement annuity, then important to consider what tax bracket you're on in terms of the retirement tax tables, and is that tax bracket higher than the tax bracket you would have been on the marginal tax brackets. Important to compare those two when deciding whether you want to put the contribution into the retirement annuity. So that's the first instance where you can make use of a retirement annuity in your retirement. The second instance is in terms of the tax-free portion that you have available at retirement. And if you do not make use of your full tax-free portion at retirement, then it can become highly tax efficient to contribute to the RA and make sure that you use your full tax-free portion that is available to you at retirement. And if you've watched my previous videos, you'll see that in some instances, your tax-free portion can be higher than 550,000 Rand if you've made excess contributions in the past. And then two other common instances also is where if you're a member of the GEPF prior to 1998, you would also have a tax-free portion that's greater than 550,000 Rand. So if you were a member of the GEPF prior to 1998, and then at retirement, you've only withdrawn the 550,000 Rand as a tax-free portion, there's a good chance that there's still a tax-free portion that is available to you. And if that is the case, you can then simply take your retirement income, contribute it to a retirement annuity, get the deduction in terms of your taxable income, so you're saving tax as per the marginal tax rates, and then immediately withdraw that contribution from the retirement annuity. And if there's a tax-free portion that's available to you, you can withdraw that as a tax-free amount. So if there are excess contributions that you haven't drawn as a lump sum from a retirement fund, then there's still a tax-free portion that's available as per the retirement tax tables, and therefore in your retirement you can make use of a retirement annuity to save you tax. One way to determine your excess contributions is to do a tax directive simulation. In this way, you can see exactly what your excess contributions are, and using a tax directive simulation, you can also identify your total tax-free portion that is available to you. And something else to be aware of also is that if you're making excess contributions to a retirement fund in that final tax year just before your retirement, just an FYI for those that may not be aware, excess contributions are contributions to a retirement fund that are above the limits. So any contribution to a retirement fund that's above the limits that you are allowed to make for that tax year, those contributions do not count as a tax deduction, and you don't get the tax rebates for those excess contributions. And therefore, because of that, those excess contributions are added to your tax-free portion at retirement. So if you have excess contributions, it'll increase your tax-free portion. So if you've made excess contributions in that final tax year, even if you do the tax directive simulation right before your retirement, those excess contributions in that final tax year are still not on record at SARS until you do your tax returns the next year. So when you do your tax directive simulation to check the excess contributions, it won't include that excess contribution for the final year. So you can take the tax-free portion out at retirement, but then in the next year when you do your tax returns, those excess contributions will again be available for you. And if that is the case, you can then use the retirement annuity and then withdraw the lump sum from the retirement annuity as a tax-free amount and use that additional excess contribution. All right, so those are the two common instances where a retiree can use a retirement annuity as a tax savings tool in their retirement. Okay, that's my last tax saving tip for this retirement series. If you have any questions on it or any other queries on retirement income planning, please do feel free to reach out. We are heading into December, so have an amazing festive season. Keep well. Goodbye.